everybody. Good morning. Welcome, welcome, welcome. Welcome to the second quarter of 2023 economic update. Today we're going to start off on a little bit of a different note. I know that all of you are probably pretty fatigued of hearing about inflation, interest rates, and the Federal Reserve. And luckily or unluckily, we have a little bit of a different topic to start with today, which would be the U.S. banking system. Obviously, as we saw over the course of March, the unraveling of Silicon Valley Bank, good old-fashioned bank run occurred. So let's talk about that. Let's talk about exactly what goes on behind the scenes within a bank once you've deposited your money. So the way that the U.S. banking system essentially works is we have a number of depositors, people like us, who hold our money at a certain institution in a checkings or a savings account. And despite what many people think, the bank doesn't hold that money in a vault behind the counter. What happens is they take our deposits, they keep a ledger of how much money we're holding within each of our accounts. But then beyond that, your money is essentially pooled with everybody else's money in the bank. And based on the amount of deposits, the total value of deposits, and based on the size of the bank, things of that nature, the bank is required to hold a certain amount of those deposits in reserve at any given time. That is required. That's where regulation steps in. Anything beyond that reserve amount, the bank can do with it as it will. So oftentimes they're taking those deposits and lending them out in things like mortgages or other types of loans, or they're also investing those deposits in what are typically very safe investment options, things like treasury bonds. Okay? So we have our reserves, which is meant to take care of the day-to-day operations of the banks, the withdrawals, the deposits, and anything beyond those reserves is getting invested, things like loans, mortgages, and treasury bonds. Okay. What happens when a bank run occurs is that investors or the depositors of that bank start to have fears around the overall solvency of the bank itself. There are fears about the financial stability of that bank. And what happens in a bank run is all of those deposits come running to the bank all at once asking for their deposits. What often happens is that the bank, as we've talked about, does not have those deposits on hand and is forced to liquidate part of its portfolio at a loss. In Silicon Valley Bank's case, they had to liquidate large portions of their treasury bonds at a loss. What ultimately ended up happening is Silicon Valley Bank ended up folding. They closed their doors, filed for Chapter 11, and pieces of the bank are now being sold off. The fears in the market was that this might not necessarily be an isolated incident. The fear was that there could be other banks out there that could deal with this same problem if depositors came running. However, for better or for worse, the federal government stepped in and guaranteed Silicon Valley Bank customers their deposits back. Okay? So this is an important point. This is something that we should all, especially when it comes to our own financial planning, retirement planning, it's all something we should be aware of. There is something called FDIC insurance out there. All major banks carry FDIC insurance, meaning for each account that you hold at a bank that is FDIC insured, each deposit is insured up to $250,000. Okay. $250,000 of your money is guaranteed within each account that you hold. Now, many of us probably don't have $250,000 in a single account. So a bank run like this wouldn't necessarily affect us. We have FDIC insurance on our accounts. We would not be impacted. The government is guaranteeing up to $250,000 of our money. The flip side for Silicon Valley Bank was that these tech companies who worked with Silicon Valley Bank, the bulk of their deposits were derived from tech companies who banked with Silicon Valley Bank. These types of companies often hold far more than $250,000 in these types of accounts, in their operational type of accounts. And as a result of that, the fear was that Silicon Valley Bank depositors would essentially lose all of that money above the $250,000. So that would essentially be millions and millions of dollars of technology companies' money that would essentially have evaporated. That would have spread like wildfire. The tech sector, which is already struggling, would have struggled further. And once again, the fear is that this would have spread to other institutions, other sectors, and things of that nature. So for better or for worse, the government did step in and guarantee those deposits. That's essentially how a bank run works. That's essentially how our banking system works. Now what's being called into question is more regulatory oversight into our banks. It calls into question how banks should be behaving in terms of investing our deposits. How much should they be holding in reserve at any given time in order to protect the solvency of the bank? So there will certainly still be questions swirling as we move forward regarding our U.S. banking system. Will there be further regulation on the banks? Will there be additional solvency issues in regional banks or smaller banks, things of that nature? So that will remain a primary driver for market movement going forward. It's already caused quite a bit of volatility, and I wouldn't expect that to go away anytime too soon. Beyond that, we come back to everyone's favorite topic, inflation. Inflation is still the underbelly, it's still the driver behind the overall macroeconomic sentiment among investors. Inflation throughout the first quarter ran about 6%. 6% is not sustainable for our economy. If prices were to continue to go up by 6% per year, we would be in a bad place very quickly. It's not something that we haven't dealt with before, but as a result of inflation, investment valuations, the American consumer tends to do very poorly in times of stagflation or high inflation. So the primary focus for the Federal Reserve remains to be get inflation under control. That is the one of two mandates that the Federal Reserve has. They will continue to press on the interest rate front until they feel that they have attained a healthy level of inflation within the U.S. That could be 6 months from now, that could be 12 months from now. In an ideal world, inflation begins to come down quite rapidly. We're already making some progress, but the closer we get to that 2% target, the better off we are. The more investors will be able to relax, the more the Federal Reserve will be able to relax and potentially plateau interest rates or begin bringing interest rates back down. Now, before we can get to that point, inflation must come down, prices must come down, the U.S. consumer must start feeling some ease in terms of pricing inflation. And so there's still several steps to go, but the end game remains to bring inflation under control, at which time we can start to think about the next growth cycle. We can start to think about company fundamentals more than anything else. We can think about company profitability and the health of the U.S. consumer and U.S. households and balance sheets and things of that nature. So until that time, it continues to be a slow and steady slog through the inflation mud, hopefully coming down sooner rather than later. But I would encourage you to remain cognizant of exactly what's driving the market, primarily being banking and the U.S. banking system and the liquidity of the U.S. banking system, as well as inflation and what the Federal Reserve plans to do going forward. That's it for me. That's all you have for this quarter. Please don't forget to check out the links provided in my quarterly newsletter, and I'll talk to you newsletter enthusiasts next quarter at this time. Have a good one.